Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $390 million in assets, serving clients in 31 states. Indiana offices are located in Anderson, Fishers, Lafayette, Rensselaer, as well as Sonoma County, California, and Bozeman, Montana. This show is for educational purposes, and you are strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 1-800-928-4001 at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Ken Dilger.
We have got a lot for you today on the show. If you are new to Consider This, we're in several new markets here recently. I'm a certified financial planner. We're a registered investment advisory firm. We manage money. But I also was a professor at Purdue University where I taught financial planning. We've been doing a radio show for a little over 20 years. Ken is a friend of mine, so we kind of do this show together. Where we're coming up with ideas and concepts of things that we need to consider. You will not hear us talk a lot about the market in terms of the stock market and where it is and what's driving it. We do that in a weekly newsletter that goes out called The Market Carver. You can go to our website at yourlifeafterwork.com and get signed up for that. It's free. It's usually 3 to 5 minutes long. And what happens is I will tell you, or my CFA, Adam Harder, I will tell you the 2 to 3 things that we think happened that were most important in the economy the week before. So it may be about Chinese stocks, it could be about tariff discussions, but things that we think could really be impactful inside of the market. Today we've got some great questions from Investopedia. Ken, I think a lot of it's going to be around tax diversification in terms of if I have money and if I have choices, I've got assets, and I want to do something like home improvement or pay off a car, or what type of an IRA should I buy? You know, where those funds should come from and how to be able to get them out. Now, one of the challenges we're going to deal with today is a question that came from a family at 37 years of marriage that's suddenly going through what they call the gray divorce. And it apparently it happens more often than what I knew. But I was asked to come through some of the questions, especially on the retirement side, of things that they need to be considering. So we're going to walk you through that. Few other questions that came in, again, from the Investopedia side. But if you've got something you want to know, that's what the show is all about. So send me an email. Consider this at yourlifeafterwork.com. Don't forget to go to the website, get signed up for the Market Carver. There's other newspaper articles that are there, previous radio shows, things of all sorts of different topics that we've covered from different emails, different questions that have come in. But you can go through and you can look at them and search for certain things that you need to find. Hey, you're listening to Consider This again. I'm Joe Clark, along with Ken Dilger. You got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. Ken and I will take a break. We'll be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance: retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 1-800-928-4001. Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Well, good morning and welcome to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
And we are happy to have you along. Hope you've had an outstanding weekend enjoying this crazy weather in good old Indiana. From 80 to 30 is kind of an interesting thing. But
it's been beautiful. Today's beautiful, and
I love it. I really, really do.
I don't mind the cool weather, Joe. I really don't.
I don't want to. I can do without the white stuff, but you can do the other. It's hard to find a golf ball in the white stuff. But anyhow, I brought up the weather. Typically, when somebody brings up the weather, it's because they have nothing else to talk about. I got to ask a tough question, so we've got to deal with a tough topic that I really, really don't like, and so I'm trying to belay the, getting there. But I had somebody call and say, hey, we've been married for 37 years, and you're always scared of the next sentence. Somebody's sick, something's happened. In this case, it's a divorce, and they're not one of the families that we take care of, but I will probably end up having to take care of her before all of this is over with. And the question was asked, what do I need to consider? Right. So they knew how to bait me, right? The name of the show, if you're not familiar with it, is Consider This. And so she knew how to get my attention. What are the things that I should consider? And so I went through and started to do a little bit of work on it. And I'm going to ask you right from the beginning, once Ken's in the mortgage industry. So once somebody has their mortgage and it's already done, and then they go through a divorce, that's really out of your bailiwick, isn't it?
Well, not correct. If people get divorced, if both the husband and the wife are on the mortgage, usually the court dictates who gets the house,
right?
And the other person has about 6 months to refinance the other person off the mortgage. So in a divorce situation, we have to refinance the house out of the husband's name into the wife's name, and hopefully there's enough income from the wife's
to be able to qualify.
So it's a sticky situation, and we can't start it halfway through. We have to have the final divorce decree, assets separated, and so forth. So
we've seen it a couple times where people have come in and they're still on the mortgage 5 years later because nobody could get it refinanced. And it wasn't like, you may get a divorce, but that doesn't mean the bank's going to let anybody off the hook that they don't have to let off the hook.
Correct.
And that's where it gets to be really entertaining or challenging, whatever you call
it's very challenging just because the person who is getting divorced, they're still liable if they're still on the mortgage.
Absolutely.
So they can't
may not be able to go get another mortgage on their own.
Correct, because they still have that liability on their sides. Yep. And if somebody gets really, really dirty, they can start missing a few payments and it goes on that other person's credit report where it really shouldn't.
Yeah.
Then that gets really tricky.
Yeah, ugly.
Yes.
All right, so let's work through it. There is a base of things. When people tell me, say, Joe, I'm getting ready to retire, or I'm thinking about taking a pension buyout where you get a lump sum. We've got a guy doing that right now that we're going through. There's about 13 things that we automatically think of when somebody says, should I take that lump sum or not? And so I've never done this before. So what I kind of went through is said, okay, if I knew somebody was going to go through a divorce, what are the things that we need to talk about? Obviously, retirement is one of the first ones. Right, so we call it your life after work, by the way, but what we're talking about is retirement asset. So you could have a defined benefit plan. The defined benefit plan is a pension, right? So in the NFL, I think you guys have a pension system.
Correct.
If you played enough years where they're going to send you a check for the rest of your life once you reach a certain age.
Correct.
Okay, that's called a defined benefit. The 401k that you've got now, where you put money in, is called a defined contribution. And that's where you put money in on a monthly basis, and the employer typically matches some money with it. If you're self-employed, like by definition I am, I get to put it in on both sides. I get to put it in as the quote-unquote employee, and I get to put it in as the employer. In fact, I have to put it in for me, which is kind of interesting. If somebody has a 401k, or if you're in the not-for-profit world, a 403b, that's money that can be rolled to an individual retirement account in your name. So, God forbid, Barb and I got a divorce, and if the judge wanted to, the judge could issue what's called a QDRO. It stands for Qualified Domestics Relation Order, and that lets me take money out of my 401k and fund her IRA without having to pay the tax penalty. It's the only time a spouse living can ever put money in the other spouse's retirement plan. Okay. So I got asked a few years ago when under the Obama administration, one of the things that they were saying was when your 401k got to a certain level, you would no longer be allowed to participate. You couldn't put any money in it. And one of my students at Purdue said, "Professor, what are you going to do?" And I said, "It's real simple. I'm going to fly Barb to Vegas. We're going to get divorced. I'm going to have the judge tell me to take my money out of my 401k and put it in hers. We're going to get married and come back on the same plane." And and they looked at me and go, "You are nuts." And I go, "No, I'm just dedicated."
Would it work? Would that work?
Absolutely would have worked. There's no way. There was no way for them to be able to enforce it. But the important part is you can never transfer financial assets from one name to another name without a judge saying that you can do it. And then it's, like I said, it's called a QDRO. So sometimes you have a QDRO for the pension if you had a defined benefit plan, right? And you've got to listen to this part very, very carefully, because we go through this. We don't have a lot of divorce people in our firm, in the families that we take care of, but we see this happen every now and then. So let's say I don't have a defined benefit plan. You do, Ken. So you and your wife go through a divorce. She, not you, she has got to be diligent enough to file a QDRO with the NFL in order to get her part of your pension when that age is attained. And so many times people assume that, well, it's Ken's pension. Ken's obligated to do it. No, not so. No. It's her attorney's job that has to be able to get that filled out. So one of those questions you have to ask, is it a defined benefit or is it a defined contribution? And is the judge willing to let you do a QDRO? Remember, not all assets are the same, right? So if your spouse's income is going to be significantly lower than yours, then the best assets to transfer to her are ones that are tax deferred, right? Because that way she's going to pay the taxes at her rate, not on yours. Now, this is another very, very important thing to remember. If the judge issues a QDRO, Ken's under 59 and a half by a long shot. So if the judge issues a QDRO that says, you've got to take $200,000 out of your 401k and give it to your wife, many times the attorneys will say, well, just send it to her IRA. Perfectly legal. If the judge signs off on it, perfectly legal. No 10% penalty, no taxation, because it went from an IRA to an IRA. All we did was swap names. The challenge here, however, what people miss is your wife is under 59 and a half. And now that she's divorced, she may need access to some of that income. And if she's already put it into an IRA, there's no backsies. There's no do-overs, right? So that money the amount of money that she needs today needed to actually go outside of the IRA into her checking account. Again, because of the judge's orders, there's no 10% penalty, but there is full taxation on the money. So when you're dividing up assets, especially a 37-year marriage, there's a lot of assets that are there in a lot of different ways. You really want to think this one through and make sure that you've got it the most efficient way you possibly can. Hopefully it's not a divorce of hatred. It's just not working anymore. But let's not throw away money that we don't have to. Be diligent in the process and think it through. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. You got a question or comment, shoot us an email, considerthis@yourlifeafterwork.com. Believe me, we do talk about more fun things than this. We're going to get into the S&P 500 and quiz Ken here on his knowledge of the beast, the most tracked financial instrument on the planet. So again, consider this at yourlifeafterwork.com. Don't forget to get signed up for the Market Carver when you're there. We'll take a break and be right back.
Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
Happy to have you along. Hey, if you're listening to us on the radio, outstanding. We certainly appreciate it. Believe it or not, there are some people who want to watch this being videoed. So Ken and I are on the camera right now. things being recorded. If you want to watch or find out when we do that, we'll have this streaming eventually so you can watch it while we're in action. I've got a whiteboard behind me, so I'm going to draw. Obviously, if you're listening on the radio, you won't be able to see it. But if you want to go to our website at yourlifeafterwork.com, I am sure that somewhere or another it's going to be put up there. So, Ken, when I say the S&P 500 to you, what does that mean?
Is that the biggest 500 companies in America?
Not the biggest, but they are 500 very large companies. Okay?
Publicly traded.
Publicly traded, United States based. So
okay.
One of the quizzes that you may get in life is, what is an ADR? Toyota is a Japanese company. Toyota is certainly very, very large. Toyota is not in the S&P 500 because it's not American based. The ADR stands for American Depository Receipt. Some of the pharmaceutical companies are the same way. When they did the tax inversion and went to Ireland or other places like that, they're no longer U.S. based, so they can't be in the indices. Now, the funniest thing about the S&P 500 to me, the funniest thing about it is that it is the most tracked index on the planet. So
why is that?
It's the United States market's the largest market, and it's just become the proxy of what it is that people want to watch. A guy back in the 70s named John Bogle built a small little company called Vanguard. And he was the one that came up with the idea of turning this into an investment vehicle. Now, if you've listened to me for many, this is year 20, I think, for the radio show. If you've listened to me very long, or many of the other people that are out there that are honest, this was never designed to be invested in, ever. And yet, that's where the extreme majority of money is tracked. So what is the S&P 500? Well, back after the Great Depression, Standard & Poor's was commissioned to try to help create a proxy, if you will, for the United States economy. And the theory behind that is that in our economy, there is a peak, and then you get a contraction. So if you're thinking about a clock here, let's call high noon, 12 o'clock. That's the peak. 3 would be the contraction. 6 would be the recession, and 9 would be the expansion. And the theory is, as you traveled this clock, that it was a natural economic cycle that we would go through. And the theory was there are some companies, some types of companies, rather, some sectors, if you will, that would do better between the expansion and the peak, let's say industrials, for instance, where there are other companies that would do better in theory, sectors, in theory, that would do better between the contraction and the recession. So think consumer staples. You have to have toilet paper regardless of how bad stuff gets. So the idea is that they went through and they created an indice, if you will, of 500 different companies that best represented the United States economy. Okay? So you've got consumer staples, utilities, materials. One of the new ones that was just added in was essentially internet communications, so to speak, if you will. The social media, some of the big ones like of that nature. But you got financials now. Financials weren't always included, by the way. But you've got all of these sectors of the economy, and they're all inside of this thing. Now, when it was put together, they didn't care about the size of the company. What they were trying to do was to look at the individual sectors to give the economist, Ken, a better idea of where we were on the clock, right? So it's, if you will, it's a lagging indicator. The economist could go, hey, we think we're in a peak, and they could look at see what the market had been, or see what the companies have been doing, not from a stock price, but from what the actual earnings and revenues were of those companies, and go, yes, it's confirming, the companies are confirming that this is really where we are in the economy. Bogle then decides, this would be a wonderful thing to invest in. And just a brilliant, brilliant idea. He's a billionaire. I'm not. But when he put it together, I will argue, and have always argued, that things were different when he did it than with where we are today. When you look at the S&P 500, and we've talked about this on the show before, it is market cap weighted. Market cap stands for capitalization. So what's that mean? Well, you take one share of a company's stock, the current price, times the number of outstanding shares. But you've got a dramatic difference in the number of shares that are outstanding. Microsoft, when I looked at it the other day, is about 7.8 billion shares of stock. Harley-Davidson was down to 230 or 40 million shares of stock. Huge difference. So it's not the price. It's the price times what we call the float, or the number of shares of stock that are outstanding. Okay?
Mm-hmm.
And the more market cap moves, the bigger the pieces of pie become. So technology is now the largest part of the S&P 500 because it's done the best over a period of time. It's the one that's outperformed. When we went back to January 1st of 2000, if your parents had money in the S&P 500, which they probably did if they had a 401k, I would tell people 40% of your money is in the technology sector with negative net earnings. And people look at me and go, "You're crazy," because they hear the word S&P 500, they assume it's divided equally among the 500 companies, and not by a long shot is that the case. Okay? So it's market cap driven. Now, there is an indice out there that is actually equal weighted. So we look at the S&P 500 equal weight just to see how it's doing relative to the big brother. And when we looked at the end of the third quarter, so the end of September, for the S&P 500, a full 25% of the gain was Amazon. All right, a full 25% was Amazon. 2.5% of the index went up because of Amazon's performance. 1.5% because of Apple. You got into the top 10 companies that produced the majority of earnings, and it was staggering how much the market had really moved. I referred to it as the 10 versus the 490, because there were 10 companies that really drove that whole move, which is why when we had some of this recent market volatility, those were also the ones that got hit the hardest.
So let me ask you this, Joe. Are those, say, top 10 all in kind of the same quadrant?
Same sector?
Same sector?
Almost all of them were inside of the technology or information area. You could argue that a couple of them may have been consumer discretionary, but for the most part, they were all there. And that's the craziness. So when we look at this equal weighted, it wasn't doing near as well as the capital weighted, because the lion's share of the performance were those bigger companies that were out there. But when you look at your 401k, folks, this stuff becomes critical, making sure that you understand what's happening, where your money's going. And I'm not telling you have to sell the S&P 500 and get out of it. But one of the reasons we like exchange-traded funds is I don't want to own all of the pie, all of the pieces of the pie all the time in different economic cycles. I want to own energy. In other periods of the economic cycle, I don't want to own energy. And with the world of exchange-traded funds, you can kind of pick and choose which part of the pie you really want to own when, and really do some interesting things in your IRAs and places like that where there's not a tax treatment. But shockingly enough, I would never have guessed this, but between 1963 and the end of 2017, there had been 1,259 changes inside of the S&P 500. I never would have thought it was that high. Averages about 23 changes a year, most of the time by mergers or acquisitions. All the companies have to be at least 5.3 billion of market cap or above. But things change. It's an amazing world we have out there. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. You got a question or comment? Shoot us an email. considerthis@yourlifeafterwork.com. We'll take a break and be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance: retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. Financial Enhancement Group can be reached at 1-800-928-4001. Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
And we are happy to have you along. Appreciate you taking the time out of your day to listen to the things that we have to say and to send us questions We get a lot of them that come from Investopedia. Somehow or another, I wound up in their top 100 advisors for 2018, and so they send me questions. I'm supposed to type out answers. Sometimes I do, sometimes I don't, but I do try to bring them to you here on the radio show. So go ahead, Ken, you're in charge.
All right, question number 1, Joe. Is it a good idea to have a brokerage manage my investments, and if so, how do I find a firm to do it for me?
Okay, so it's a great question. Obviously, I'm biased. We get paid to manage money, so my answer would always be yes. I don't do anything else. I think it's always been interesting. You know, it's nobody would expect me to be able to go work on my car. Nobody would expect me to figure out how to do medical stuff or a lot of the things that I do. You know, I always tell people I can fix anything with a phone book, right? As long as somebody else calls on the other end. But there's something about money where people think you're supposed to be able to do it on your own. And it's a very confusing and complex place. So my answer is yes. Now, what happens, though, is where you get into the type. So there's 2 different types of people who manage money. There's people who sell stuff. That goes under what's called suitability, where they're kind of the ones that are providing you opportunities, but at the end of the day, Ken, it falls on you to make the decision. Myself, the Financial Enhancement Group, about 8% of the companies nationwide, about 6% in Indiana, fall under what's called legal fiduciaries, where we don't sell anything. I don't pick up the phone and call you and say, what do you think about Amazon or Starbucks? If I buy it in my account, I buy it in yours. If I'm selling it in mine, I'm selling it in yours. So we're kind of on the same thing together, but it's not, I don't get paid based on what we own or the amount of transactions or any of that other stuff. We get paid flat out to manage money. So I think the answer is yes, you should. I would also always tell you to seek out a fiduciary as opposed to somebody who merely sells stuff. Okay? Question number 2.
All right. I recently retired at the age of 77.
Wow.
Is there a time limit on rolling over my 401k for my former employer?
No, there's no, as long as you have enough money that's in it. Some plans will tell you at a certain dollar figure that if you retire or separate from service, as they would say, and you don't have enough money in it, that they can force you to roll it out. Assuming you have enough money in there, you do not have to roll that money out of there if you don't want to. In my mind, if you've got a fiduciary, many times it makes sense to roll it out to an IRA because the fiduciary has more opportunities to be able to manage it. But in a 401k plan, typically you're going to find lower charges, lower expenses that are inside of it. So you really want to weigh out the options that you have. But no, you do not have a time clock, assuming you've got a lot of money in it.
Gotcha. All right. Question number 3. What is the best IRA for someone who is 35 years old?
So it's not a function of age. It is a function of income and a function of your future. So if you would have asked me at 25 years old, playing in the NFL, if you should have had a Roth IRA, I would have told you, well, 1, you didn't qualify because your income was too high, right? And 2, there's a good chance that your tax rate back then is going to be more than what it was going to be in the future because of the income source. So, the question number 1 is, what do you qualify for? How much money do you have to be able to put in? And is your income too high, or are you eligible to put money into the Roth IRA as an option and a choice? And then secondly, you ask yourself, do you think your future tax rate is going to be higher than your current tax rate, right? So I believe in tax diversification. It's one of the things that we teach and preach around here. So I have some money that is after tax that we would call, we refer to it as after tax bucket of money, if you will. Money that's tax deferred, the money that goes in my 401k that the employer part of me puts in has to be tax deferred. And then the Roth 401k is money that I'm able to put in. Remember, there's no income restriction in a Roth 401k. There is in a Roth IRA. So I would look at them at 35 years old and say, hey, what's your future look like? What's your income today? Most likely it would be a Roth IRA.
Gotcha. Next question. Which type of interest is better for my situation, simple or compounding?
Yeah, go ahead.
And the question is, I am getting a home equity line of credit for $20,000 to pay off credit cards. And I think in my experience, it'd be simple interest, because on a HELOC, which we do a lot at Milestone, when you pay down your monthly payment, your next interest payment goes off the residual principal amount, and not the start amount that you started with. So your monthly payment should go down as soon as you pay down the principal and interest every month, and not the same payment as compounding interest, correct?
Almost every loan that you can think about is compounding. Okay? It's either compounding or reverse compounding, right? So what you said is exactly right, Ken. It's just terminology, right?
Okay.
So I used to give the kids at Purdue a quiz. I told them that they had a 4% CD that compounded quarterly. And then I would ask them how much money you had at the end of the year. So you have $100, right, as your investment. It's 4%, and it compounds quarterly. And so do they have $4 of interest? Do they have $16 of interest? Then I made up one in the middle somewhere around 8. And I believe the answer was $4.60 because it compounds.
Correct.
Right? So when people see an interest rate illustrated, remember it is always annualized. Okay, it's always annualized. So if somebody says 4% and it compounds quarterly, that's just when they're adding the interest.
Correct.
Right? When you're doing the mortgages, they're actually, it's reverse. They're taking that off, which is why each payment you make, you're paying a little bit more toward principal than you were before. When you look at it, because the interest part's gone away. Now, when you look at something that's amortized, like a 30-year mortgage,
correct,
or a car loan, it doesn't work that way. Right? But it's already factored in your truth in lending statement when you show them. You tell them it's a 4% interest, and then they look at it and they go, "Wait a minute, this doesn't say 4. This says 4.4 or 5." Well, one of those things.
Right. You could think affect the APR. It's more of a closed-end loan instead of an open-end loan,
Right.
which the HELOC is.
Very good.
So.
And that is precisely the point. Next question.
All right. All right. My company offers a 401k and a Roth 401k, and I currently contribute to both. Should I put all of my contribution money towards the Roth 401k?
So here's the challenge with that. It's you're asking me to help you make a silo decision. You're giving me one statement and asking us to give you an answer. And really, when you look at money, when you look at your world of finance, remember the 5 critical elements: your life after work, the annual tax planning, the investment playbook, life happens, the good and bad and ugly of life, and the estate plan. Right? I can't give you that answer without knowing other circumstances. What I will tell everybody is a Roth is always better for your beneficiary because you've already paid the taxes. A Roth is not always in your best interest. So again, if this is your last year of working and you're at a really high income bracket and you're going to retire and you're not going to make as much money, or your tax bracket's going to go down, no, you probably want to do the tax deferred. But given the opportunity to be able to have that tax diversification, some money that's in the Roth, some money that's tax deferred, some money that's already been taxed, that's the stretch that I would tell people to try to get on, to make sure you have that tax diversification. We don't know what the IRS is going to do with the tax rates in the future, right? So we want to give ourselves plenty of opportunities and options to be able to shift based on where the tax world is at that point in time. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. You got a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com. And when you go, don't forget to get signed up for the Market Carver. You can also listen to other radio shows from the past as well as our newspaper column. We'll take a break. Be right back.
Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. For the last 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share that with you, what we use to protect more than 700 families, more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry before the crash in 1987, and I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and as a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the Internal Revenue Service. You can reach us at 800-928-4001 at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group Incorporated, member FINRA and SIPC. Again, that number is 800-928-4001, and you can reach us at yourlifeafterwork.com.
Well, good morning and welcome to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
We are happy to have you along. So we're answering questions for our friends from Investopedia. You have an opportunity to be able to go there. Just like people email me and ask questions, consider this at yourlifeafterwork.com. There's a place to go to Investopedia. You can put in your question and then people like myself answer it. And so you can get some various different answers. What I always get concerned about is when I read two people's answers and they're different. So there's CPAs that are on there, there's some attorneys, but most of it are people like myself in the financial world that most of us work as fiduciaries, most of us have CFPs, not everybody that's on there does. So pay attention to who it is. So go ahead, Ken.
Okay, first question. When determining the total value of my stock assets, do I use the market price or the cost basis of the stocks in my account?
When you look at the value of your account, say that again.
She goes, when determining the total value of my stock assets,
okay,
do I use the market price or the cost basis of the stocks in my account?
So those are some good words. I'm surprised she didn't know the answer to that if she knew the word cost basis. Cost basis is what you paid with money that's already been taxed to buy an asset. So every now and then I will find an IRA that actually has basis in it. Because they weren't able to deduct the contribution. They weren't eligible for a Roth perhaps, and so they've got basis in it. But most of the time IRAs don't have basis. It's you've deferred everything that you've put in, or you've already paid taxes on all of it because it's a Roth. But in a brokerage account, if I buy a share of a stock or of a mutual fund with $1 that I've paid taxes on, then that dollar would be considered my cost basis. But when I do a financial statement, Ken, I'm going to tell you what the current fair market value is. So if it's gone to $2, then I want to know that the asset is worth $2, and that's what I would report. Now,
and that's based off the stock price at market
today.
Condition.
Right. So when somebody comes in to do a family update, we print the data right off for that day to say, hey, here's what your fair market value is of your portfolio the day before. Now, one of the things in my industry that really irks me, right? I don't like games. And the bottom line is when people come in and they look at a statement, the SEC does not make us, and they does not make us differentiate between IRA assets and non-IRA assets. So you come in, you look at your statement, and it says you've got $1.8 million. All right. Well, it could be $1.8 million all after tax. It could be $900,000 after tax, $900,000 in a 401k, or it could be from the sale of a company and it's all been taxed, right? Those are three very different scenarios because when you've got an IRA or a 401k, you really are in partnership with the IRS, except they get to determine how much you're going to actually have to pay them later on at the end, at the end of the day. So do pay attention to that. I think, I used to get asked all the time, especially before the Roth recharacterization rules got changed in the end of 2017. So, Joe, why are you the only person that we hear constantly preaching doing Roth conversions? And, because you don't read about it in any of the big wirehouse information or, any of those places. And the answer is every time you did a Roth conversion, Ken, you paid taxes on that money. That's money that came out of an account that I was managing, right? So suddenly you did a Roth conversion and I get paid less. And the boards at the big wirehouses are not going to say this is a really good idea, right? Let's go out and pull for our own things. They prefer you to have tax deferred money. That way there's no obligation from a tax standpoint of being able to move money around. Here we want to help build the tax diversification and manage it appropriately. Next question.
All right. So the topic is, what account should I use to finance my home improvement project? I own my own home and the mortgage is paid off and it's valued at approximately $300,000. I am 53 years old and have no debt and have a beneficiary IRA.
And what was the first part of the question?
What account should I use to finance my home improvement project?
Oh, home improvement
project.
project.
So it's either taking money out of the house or an IRA.
So if it's truly to improve your home, right? And here's one of the mistakes that I hear people say a lot. You can deduct mortgage interest. I hear people say that all of the time. Well, ladies and gentlemen, you can only deduct mortgage interest if you itemize. And keep in mind, married filing jointly starting in 2018, your standard deduction is $24,000. So there are no more miscellaneous expenses. Your what we call the SALT tax, your state and property taxes, are limited to $10,000. So you've got to have one whopper of a home or be a very large charitably gifted inclined person for the most part in order to be able to take anything other than the standard deduction. So the mortgage interest is usually, in my opinion, not going to be deductible for the average American family going forward. Now that said, being in the mortgage industry, if it's used for to actually rehab a house, it is deductible.
Correct.
Now, Ken cannot get you a what we call a HELOC, home equity line of credit, if you're going to use it to go pay off your credit cards.
We can.
You can. They just can't deduct it.
Correct.
All right. Now,
yep.
I'm going to be very interested to see how many CPAs really ask this question. But that's the way the law works, and it is there. So, which one's in your best interest to get? I always look at it from a standpoint of what are my asset opportunities. So if I take money out of my house, Ken, you're going to tell me a home equity line of credit's what, 3% today, 4%?
No, it's based off of prime. Prime is what, 5.5,
okay.
5.75
so it's higher
now.
It's even higher. Wow.
And so you have good credit, you've got good income, and you usually get right around prime.
Okay.
With a 10-year draw period.
All right. So let's say we're doing it at 6% then.
Yep.
Okay. Now, if you're able to itemize, that means it's deductible. If you're not able to itemize, it's fixed. It's 6%. Right. So that's a guarantee. It's a guarantee that I would have to pay 6%. Right.
Mm-hmm.
And so then I would look at my investments and I go, okay, how much risk do I think I have to take to earn more than 6%? Oh yeah, and remember, I've got to pay taxes on top of that in order to get it done. Right. So in order to be equal, if you're at a 20%, bracket, that's another 1.5%. Now I have to earn 7.5% just to be even. Right.
Mm-hmm.
And so my choice would probably be, if I had money that was sitting around, in an investment account, I would probably use my investment money as opposed to take the money out of the house if that was truly the rate that I would have to pay. But that's how you look at it. When you come up with those pockets of money, you run through the process of, okay, there's two sides. One's tax, right? What is the tax implication, either good or bad? If it's pulling money out of my 401k or pulling money out of my IRA when I'm 53 years old, bad things can happen. I can borrow money out of a 401k if my plan document allows for it. You cannot borrow money out of an IRA ever to be able to go through that process of home improvement and to do that. If he's over 59 and a half, he could take the money out of the IRA, but he'd have to pay taxes on it, right? Same is true for the 401k, assuming it wasn't a Roth. But you've got that. You've got money that's maybe sitting in a bank account that's earning 0.5% or 1%, right? That's probably the money that I would go to the quickest, just to be able to get done. But it's a great question, and it's how you ought to think. What's the tax implication, and what is the investment risk that I have to take to be able to match that, and then to make it worthwhile? Obviously, if it's even, you certainly use the money out of investments, not the house.
Correct.
Yeah.
And most of the HELOCs that I do are variable rate depending on prime, so they could go up every couple of months as the Fed raises interest rates.
No fun in that at all. I like
definitely not.
I like predictability. That is just the way that it works. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. If you got a question or comment, something that you would like to know or hear us talk about, just shoot me an email. considerthis@yourlifeafterwork.com. You can go to our website, find other radio shows, the newspaper column, as well as get signed up for the Market Carver. Market Carver is a video newsletter we send out every Thursday. It's absolutely free. Love to have you. Ken and I will take a break, and we'll be right back.
Hi, I'm Ken Dilger, co-host of Consider This with Joe Clark. Joe is a certified financial planner and former professor at Purdue University. Joe is the managing partner for the Financial Enhancement Group, and Joe's passion is teaching people about their money so they don't make inefficient financial decisions. Find out more at yourlifeafterwork.com. The Financial Enhancement Group manages more than $390 million for families in 31 states. Join Joe and me as we address your questions about money and 5 critical elements of finance: retirement planning, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. Each week, we will tackle questions that can make a difference in your life. The Financial Enhancement Group can be reached at 1-800-928-4001. Financial Enhancement Group is an SEC registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA SBIC. You can find out more at our website, yourlifeafterwork.com.
Good morning and welcome back to Consider This. I'm Joe Clark.
And I'm Ken Dilger.
And we are happy to have you along. All right, Ken, we're going through some questions here that came in through Investopedia. A couple that got emailed in. If you've got a question or comment, something that you want us to address, email us, considerthis@yourlifeafterwork.com. Go ahead, Mr. Dilger.
So here's the topic. What should I do with my extra money now that I'm done paying off my student loans? I am 25 years old. I am on track to pay off my student loans in the next few months.
Good for him.
Yeah.
Or her, whichever.
Correct. I have $9,000 in a high-yield savings account, 1.85%.
Okay.
What should I do with that money?
Okay. Great question. So here's one of the rules, and again, I'm going to assume at 25 that your income's not so high that you're not eligible for a Roth IRA. One of the things that you need to remember where a Roth is entirely different than a traditional IRA. If I put money in a Roth IRA, and if I'm under 50, you can put in $5,500 a year. If you're over 50, you can put in $6,500 a year. It's called the catch-up provision. But you can always get Roth contribution money back. Right? Now, that doesn't deal with market volatility. But if I put $5,500 in a Roth IRA, and something happens 6 months down the road, and I need to get it out, there's no penalty for that from the IRS. I can reach in, and I can get the $5,500. Now, I can't get the growth on the money, hoping that there was some, but I can get the $5,500 back. So anytime I see a young person like that doesn't have a put and take account. Put and takes when you put money in and you take it right back out. It's kind of like what we do for people for vacation funds and things like that, where it's a constant inflow, outflow kind of deal. Doesn't work for that. But when somebody tells me that they've got emergency fund money, and I look and the money's been sitting there for 5 years, right? That money definitely belongs inside of a Roth IRA because you can get it back if you need it, quote unquote, an emergency. But more importantly, that's tax-free money. And every now and then somebody will look at me and go, yeah, but I don't want to take a risk. I don't want to take a risk on it. Well, remember, you can make a Roth IRA be a CD if you want to, right? And the bottom line is when the clock strikes midnight, December 31st, you have no ability to go put that other $5,500 back inside of a Roth IRA. You know, Barb and I have been able to build a reasonably nice-sized Roth IRAs because of a policy called the backdoor that we were able to use starting back in 2007. We were able to do a backdoor Roth where money actually goes into an IRA first, and then we convert it to a Roth. So I can't go in and get that money out if I need it because I'm not 59 and a half. Whereas a Roth contribution, if you're eligible, if I'm 25 years old, and I got $9,000 sitting in an account and my student debt's paid off, again, kudos to you for that. But if that's the case, you can darn well bet that money is going inside of a Roth IRA. And if you're married, you can put it in for your spouse too. Again, assuming your income's not too high.
Gotcha. All right. I am 64 years old and just retired. I have a 403B for my education career.
Right, so that means it works for a not-for-profit.
Correct.
403B is very, very similar to a 401k. Except they're usually attached to insurance companies, which always annoys me.
All right, and the question is, my advisor is suggesting that I convert the 403B to a traditional IRA.
Mm-hmm. Perfectly legal, no taxes, easily done, but he's doing it because he wants a commission more likely than not. So he's probably trying to roll it from a 403B, which is an annuity provider, almost always from an insurance company. And he's going to try to roll it into an annuity where he gets paid again, right? So your risk, is that the end of the question?
Yes.
Okay. So your risk of doing that is typically the fees and expenses inside of a 401k are going to be lower than what you're going to find in an IRA. In a 403b, that is not always the case. Can be many times expenses that are in there, especially when it's attached to an insurance company, that may justify you being able to get it out. Now, Ken, the difference between a 403b and an IRA is your spouse has to be your beneficiary on a Department of Labor plan, 401k, 403b, and your spouse literally has to sign off. If I moved money from my 401k into an IRA, Barb would have to sign to say that that's okay. And that's because once it's in an IRA, I could make you my beneficiary if I wanted to. Now, don't count on that happening. But, in an IRA, you have those choices and those options. It's a little bit different. But just make sure that your interest and his interest are aligned. One of the books that I'm reading is called Skin in the Game, and it's by Nassan Taleb, and he is just a math wizard. He wrote a book called The Black Swan a few years ago, and I enjoy the way that he thinks and he writes. But one of the things that he says is, try not to get advice from anybody who doesn't have skin in the game, right? So, when I started the Financial Enhancement Group back in 1997, we didn't have a lot of assets. I put it all into the company and being able to build it. And, the nice part is 21 years later, I'm not allowed to, by my own doing, not the SEC, which I think is crazy. I think everybody ought to have to be this way. I don't own anything that my families don't own, and I don't, there's no investment. I have my house. I have the office building that we're standing in, that is obviously attached to the company, and everything else I have is right alongside with the people that we manage money for. And I just think that's the fair way to do it and the honest way to do it, and it's, there's skin in the game.
All right. Why does a bond lose value due to government interest rate increases and advancing market conditions?
I really wish you guys could see the board because that would help you. But if you thought about it, and it's a great question, and it's very, very confusing to people. But if you think about it, bonds function on a teeter-totter. People will tell you that bonds pay interest. Ken, bonds do not pay interest, right? They're taxed like interest, which is why people say that. But bonds pay coupons. It's a fixed amount of money. So let's say we've got a bond that pays $1,000, so you're going to get two payments of $500 a year. And it's a 10-year bond, okay? So you know what your income is for the next 10 years. And all of a sudden, the Federal Reserve starts to raise interest rates. Well, if they raise rates, right, then the value of this bond on paper goes down because it's still only paying $1,000, and a new bond may have to pay $1,100. That's why they go down. So if you just hold your arms out, if you want to know what's going to happen to your bond portfolio, they teach people this at Goldman Sachs. So seriously, this is how you get this in your head because it's very, very confusing. If interest rates go up, the value of existing bonds go down. If interest rates go down, the value of existing bonds go up, which has created a huge problem for people because bonds have just been getting waylaid with the Federal Reserve raising the interest rates again here recently. And so bond portfolios, the yield appears to have gone up, but what it meant, your existing bonds have gone down. The problem is a boatload of money is sitting in these nasty little things called bond mutual funds, right? And if it's in an IRA, no big deal. But if it's not in an IRA, the manager's in here selling these bonds because people want their money out and they're recognizing capital gains. You could very easily see on paper your portfolio go down and all of a sudden get a 1099 at the end of the year where you've got to pay tax. That's just nasty, nasty, nasty. That's why you always want to know where your money is and how it's held and invested. Hey, you're listening to Consider This. I'm Joe Clark, along with Ken Dilger. You got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. Don't forget to get signed up for the Market Carver while you're there. And just again, yourlifeafterwork.com. Consider this. Joe Clark, Ken Dilger, we'll be right back.
Hi, I'm Joe Clark, host of Consider This and managing partner of the Financial Enhancement Group. Over the past 20 years, the Financial Enhancement Group has developed a process that's straightforward and simple. I'll share with you that process that we use to protect over 700 families and more than $300 million in retirement assets. We take care of people who don't want to worry about their money. I started in this industry 2 weeks before the crash in 1987. I've been an active participant helping families like yours strive to build a secure retirement. Here's what I've learned as a certified financial planner, a former professor at Purdue University, and a trusted advisor for the last 3 decades. Nothing will separate you from your retirement like the IRS. You can reach us at 800-928-4001 or consider this at yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Incorporated, member FINRA, SIPC. Again, that number is 800-928-4001, yourlifeafterwork.com.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Ken Dilger.
What we like to call the fastest hour in radio. Ken sits here, asks questions, and wonders, where did the hour of my life just go?
I'll never get it back, Joe.
It's once it's spent, it's spent. You know, I spent my whole life saying the only thing you can't replace is time. And the older I get, the more I realize I really missed something. You can't get the time back. That's true, but we all have the same amount of time. You've got the same amount that I've got every day, right? What we have is a different amount of energy.
So true.
And once you've spent that energy, that's when it is really, really gone. So speaking of spending energy, 37 years to me seems to be a long time to go through a divorce, right? 37 years of marriage, went through a divorce. If you missed that, it was one of the first things we talked about on today's show. I got asked, a lady called in and said, hey, 37 years, it's just not working out. It's a peaceful divorce, fortunately. It's not that one hates the other. It's just just people moved in different directions. And so she asked me some things about retirement that I needed to take care of. I didn't get into the Social Security or the estate planning, so I'm going to try to hit that real quick. But the division of assets is critical. Now, at a 37-year marriage, they're over 59 and a half, and so how you separate IRAs doesn't matter as much, but certainly pay attention to the future tax situation of where people are. I tell all the families that we take care of that not all the beneficiaries are equal. You may have two kids, one has a high income, one has a low income. One's philanthropic, one's not. The assets that you leave behind in your will or your trust or even your 401k should be different based on the different beneficiaries that are there. This is the same thing. You've got a group of assets. You probably have retirement accounts. You probably have some money that's sitting in a checking account or CDs. Not all assets are the same. And when you divide up a marriage after 37 years or even 10 years, paying attention to that division of assets is critical. Under the Social Security side, one of the questions I always get asked is, am I eligible to take my husband's Social Security even though he's now my ex-husband, or vice versa? What would you say the answer to that is, Ken? Any idea?
That's a good question. I would say no.
For a mortgage application, this is important to understand. As long as you've been married for 10 years, you are eligible to file on your ex-spouse's Social Security. So we have a lady in Lafayette that has been divorced 3 times, 2 different doctors and an attorney, who has been married for 10 years and somewhere between 2 and 9 months after that in each and every case. And she will go when she's retirement eligible. She will go and figure out which one of their Social Securities is the highest so that she can get paid on it.
Can you only take one?
Well, yeah, she can only get one. But you can either get all of yours or half of your spouse's. And so these were high-paid physicians, and so I'm guessing it's going to be one of the 2 physicians. But it's just funny how
he's going to be the unlucky guy, huh?
Well, it has no impact on you. That's the other part that people don't understand. So you don't even know that they did it, and there is no impact. You just have to show that you were married for 10 years or longer. There's some crazy stuff that's out there. But
so does she get half of it? But he gets his full portion?
Yeah, doesn't impact him at all.
Oh, interesting.
It's just that she's
Never
able to
had
get
that
it.
question.
But from an income standpoint, it would matter for you to know what somebody's future income stream would be to be able to pay the mortgage payments. Hey, you're listening to Consider This. I'm Joe Clark along with Ken Dilger. Hope you enjoyed the show. You got a question or comment, shoot us an email. considerthis@yourlifeafterwork.com. Have a great week.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 1-800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 2704 Enterprise Drive, Anderson, Indiana, 46013. Be sure to check out their website for more information at yourlifeafterwork.com.